Welcome, everyone. Good morning. Thank you for joining us today. This is the second webinar from our fiscal training webinar series. And today's presentation will be Understanding the Calculation Worksheet and Contract Reimbursement. Today's webinar is being presented by the California Department of Education's Early Education and Nutrition Fiscal Services Unit of the Fiscal and Administrative Services Division. For those of you who do not know me, my name is Corey Kahn. I am the manager over the Early Education and Nutrition Fiscal Services Unit. And today I'm joined by the EENFS fiscal analysts and managers who have been busy creating and updating these presentations that will be used over the next couple months. So for those of you who tuned in last week, just like last week, we've disabled the chat box for participants, but EENFS staff may be using this feature to share links with you. Also, our team is committed to being as responsive as possible, but will most likely not be able to answer every question this morning. Please utilize the Q&A feature to ask us any questions. And when you do, make sure that you give us as much detail as possible before clicking that submit button. At the end of the presentation today, Kate Washington will be facilitating a live Q&A session where she'll go over some of the frequently asked questions that have come through during the session. And then also she will call on participants that have either raised their hand or that have raised their hand, sorry. And then if we aren't able to get to all of the questions, we'll take them back. We'll try to reach out to you later, or we may use them for developing answers to like a frequently asked questions page on our website. So for those of you who joined us last week, we tried to have participants update their Zoom name to include your agency and vendor number. That didn't go as planned. So today we're scrapping that, but we're asking that when you do submit your question through the Q&A feature that you, at minimum, just include some identifying information along with your question in case we don't get to your question. So identifying information would be something like your agency name or your vendor number. And so that will allow us to track the questions as they come in and follow up with you in case your question wasn't answered during this webinar. We will take questions through the Q&A throughout the webinar, but we are going to hold a Q&A session until the end of the presentation. So now I'm going to turn it over to your presenters this morning, and that is Joey Boyd and Jacob Lee.
Thank you, Corey. Morning, everyone. As Corey mentioned, my name is Joey Boyd, and I am a fiscal analyst with the Department of Education. Today, Jacob Lee and I will be discussing several topics, all related to understanding the contract earnings calculation and the many factors that play a part in your agency's contract apportionments, including understanding the limits of reimbursement, apportionment determination, year-end earnings differences, and contract monitoring best practices. Throughout this presentation, we'll be referring to the limits of reimbursement, so we'll begin by defining this term. Per Title V, Section 17804, contractors will be reimbursed for the actual costs that are reasonable and necessary to the performance of the contract. Title V, Section 17812, the determination of reimbursement, contract reimbursement is limited to the least of the following: the maximum reimbursable amount, or the MRA, as stated in the annual preschool contract, or the net reimbursable program cost, or the product of the adjusted child days of enrollment, or known as CDEs, for certified children, multiplied by the contract rate per CDE, multiplied by the actual percentage of attendance plus 5%, but in no case to exceed 100% of enrollment. And we're going to be referring this throughout the presentation as service earnings. It's important to remember that these are not the limits while in a hold harmless year, but let's talk a little bit what that means. Since fiscal year 2021, the determination of contract reimbursement has been limited to the lesser of either 100% of the contract maximum reimbursable amount or net reimbursable program cost. Please note that hold harmless will continue for this fiscal year 24-25 and is expected to end on June 30th, 2025. Therefore, contractors should start assessing how a non-hold harmless year may affect their reimbursement. For now, let's look at some examples of the limits of reimbursement under hold harmless. In the first example, it outlines an MRA of $250,000 with net reimbursable expenses or cost at $150,000 and service earnings of $200,000. Because net reimbursable costs are the lesser, $150,000 would be the reimbursable amount. Example 2 shows an MRA of $250,000 with net reimbursable costs and service earnings, both at $300,000. For this example, this contractor would be reimbursed their MRA, as that is the lowest of these figures. Finally, example 3 shows an MRA of $250,000, net reimbursable cost of $180,000, and service earnings of $100,000. In a hold harmless year, they would be reimbursed $180,000. However, if this was a normal non-hold harmless year, the reimbursement would be based on the service earnings of $100,000. Now we will look at the different components of the contract earnings calculation. Please note that we'll be reviewing projected contract earnings calculations. Earning calculations based on the June reports will look slightly different as they are no longer projected earnings. Reports submitted through the year take the data that you have provided on the enrollment, attendance, and fiscal reports in CPARAS and use it to project your earnings and calculate your apportionment. Since this earnings calculation is using the data you've submitted after each reporting period, it's important to review these calculations and to have an understanding of what is determining your contract earnings throughout the fiscal year. While all these figures and formulas may look very complicated, Jacob and I will break down these into sections.
Hi, Joey. Really quick,
Hi.
I'm sorry to stop you. We had a comment that someone asked if you could slow down a little bit when you're speaking.
Sure.
Thank you.
Okay, so moving on to the contract earnings calculation process in CPARAS. But as contractors certify enrollment, attendance, and fiscal reports in CPARAS, they become viewable to your early education and nutrition fiscal services analysts, who will review the reports for completion and accuracy. Provided there are no issues with the report, the analyst will approve it and the contract earnings calculation will become viewable to the contractors in CPARAS. As the graphic on the slide suggests, this is a continuous process. Each time your agency certifies a report, it must be reviewed and approved by your analyst, and the earnings calculation will become viewable based on the newly certified report data. If your agency revises the report, a revised earnings calculation will be generated from that data. An example of this process could be if your agency revised a previously certified September report, your fiscal analyst would approve the new report, a new earnings calculation would be generated, and the previous September earnings calculation would no longer be viewable in CPARAS. At this time, only the most recent version will be viewable in the system. So agencies are encouraged to save submitted reports by using the computer's print to save function. Now let's look at where to find these earnings calculations in CPARAS. Once logged into CPARAS, navigate to the reporting menu shown on the top of the slide, then select Certified Reports. This will bring you to the Certified Report section shown on the bottom of the slide. This section will display a list of all certified reports, the associated earnings calculation for each report, the correspondence from the fiscal analyst. To easily navigate to the calculation you wish to review, you can filter by the fiscal year and the report type. To view an earnings calculation, click on the calculation link next to the report name. In our example, we will be looking at a September's earnings calculation. In the next few slides, we'll go through each section of this calculation. The earnings calculation are a combination of contract terms, data from the enrollment, attendance, and fiscal reports, and system calculations. At the top of the contract earnings calculation screen, we'll see the contract's name and the contract number. Directly below the agency and contract information, we'll see the fiscal analyst's name, date, and time the calculation was approved by the analyst. Beneath the analyst's approval information, you'll find the report month, which is the example. In this example, we're using September. Next, you'll see the submission information, the name of the authorized representative who certified the report, as well as the date it was certified. The apportionment month this calculation will impact. December is displayed in this example, and the amendment revision number the earnings calculation is based upon in this example is 00, meaning the calculations are based on the contract terms from the initial contract. Now let's look at the first section of the earnings calculation, the contract terms. At the top of the screen, the maximum reimbursable amount, or the MRA, is displayed. In this example, we're using $1 million. Next is the apportionment paid to date. This is the total amount of payments that have been made to this contract, which in this example is $416,000. The minimum days of operation, or MDO, is also a term of the contract. 246 in this example. This contract has also been approved startup in the amount of $12,000. Next, if your agency participated in a VTT or an interagency transfer, you would see this amount reflected here. The exception line is listed here to prevent the temporary increase or decrease to a contractor's MRA from impacting the original preschool reserve account cap or their original set-aside requirement before accepting or releasing funds. This amount is an adjustment that impacts the calculation. Finally, on the bottom of the slide, we'll see the calculation of the contract's exceptional needs severely disabled set-aside. On this line, you'll see the calculation is taking the total MRA of $1 million and adding in the VTT exception, in this case it's 0, multiplying the result of 5% to represent 5% funded enrollment, and multiplying by the full-time exceptional needs adjustment factor of 2.4. In this example, that gives this contractor a total exceptional needs severely disabled set aside of $120,000. Jake will be discussing this a little bit more and the credit in more depth and later in this presentation. Okay, so let's look at the projection factor calculations. Until the processing of the June year-end report, all apportionments are determined by applying the projection factor to the contractor's actual reported data. The projection factor is calculated by taking the total days of operation per the program calendar and dividing the actual days of operation per the reports. As a reminder, a day of operation for CSPP programs is a day in which the contractor provides services to one or more certified children. In the example here, the projection factor is calculated by taking the minimum days of operation of 246 and dividing by the actual days of operation of 63 to get a projection factor of 3.9048. Now let's talk about the certified enrollment percentage. As a reminder, in the report submitted to CDE, days of enrollment are reported to specific categories, which are then multiplied against adjustment factors to determine the adjusted days of enrollment. In this section of the earnings calculation, CPARES will display the total certified adjusted days of enrollment. This number will be the total from all categories in all service counties. In this example, the total certified adjusted days of enrollment is 4,800.5. The next line is the total certified adjusted severely disabled exceptional needs days of enrollment. This information comes from enrollment reported in the severely disabled and exceptional needs categories. In this example, the total certified adjusted days of enrollment reported in the severely disabled and exceptional needs reporting categories, or 450.5. Please note that the 450.5 is included in the total certified adjusted days of enrollment of the 4,800.5 and is not in addition to this line. Next, the total non-certified adjusted days of enrollment is identified at 700.25. As a reminder, these are non-certified children that are in the classroom at the same time as certified children. Now we put that all together to determine the percentage of certified enrollment. CPARES calculates this by dividing the total certified adjustment days of enrollment by the total certified and non-certified adjusted days of enrollment. For the example we're using, the total certified and non-certified enrollment is 5,500.75. 4,800.5 divided by the 5,500.75 will give us a percent certified days of enrollment of 87.27%. Okay, let's move on to the attendance percentage and flex factor. Now, although contract reimbursement is based on the lesser of the contract MRA or net reimbursable costs during a hold harmless year, an attendance flex factor will still be displayed on the earnings calculation. As mentioned before, when covering the limits of reimbursement, Title V states that in a non-hold harmless year, the third limit of reimbursement is determined by multiplying the adjusted child days of enrollment for certified children by the contract rate by the actual percentage of attendance plus 5%, but in no case to exceed 100% of enrollment. The addition of the 5% as referenced in Title V is referred to as the 5% flex factor and is applied as an allowance, which is added to the actual percentage of attendance. For this example, the total attendance percentage based on reported data is 94%. That 94% is determined by taking the total days of attendance across all counties from the report and dividing that by the total certified days of enrollment. On the total attendance percentage with flex factor line, this contract's total attendance percentage is 99%, which is determined by adding the 5% flex factor to their actual attendance percentage of 94%. Okay, let's move on to reporting revenue. Per Title V, 17821, it requires contractors to report all services, revenues, and expenditures for both subsidized and non-subsidized children, if non-subsidized and subsidized children are receiving commingled preschool services as defined in Section 17700 of this chapter. This means certified, non-certified children in the same classroom at the same time. The reporting of revenue will be dependent on the source of the income and how it is expended. Revenue should only be reported when its corresponding expenses are also reported. There are multiple lines where revenue can be reported within the revenue section of the report. The restricted income will affect contract earnings calculations. Unrestricted income will not affect the earnings calculation. As mentioned, restricted income impacts your earnings, so let's discuss that a little further. Restricted income is income that may only be expended for certified children or is provided for specific limited purposes. Restricted income includes, but is not limited to, allocations paid outside of contract, ARPA funds, child nutrition program, family fees for certified children, or interest earned on apportionment payments, exceptional needs severely disabled service level exemption, prior year deferred revenue, and transfers from a preschool reserve fund. Restricted income will affect the apportionments earned as it is deducted from total expenses within the earnings calculation. So let's look at an example of restricted income on the calculation sheet. On the first line showed, the total expenses of $400,000 was reported on the submitted and approved enrollment, attendance, and fiscal report. The second line indicates the contractor reported $97,500 in restricted income. No transfer from the preschool reserve to CSBP contract was reported. And on the last line, CPARES is calculating net expenses by subtracting restricted income from total expenses to arrive at $302,500. Now that we've covered restricted income, let's talk a little bit about unrestricted income. Unrestricted income is income that may be expended for certified or non-certified children that is not provided for a specific or limited purpose. This includes family fees for non-certified children, Head Start revenue, and fundraising income. Note that the unrestricted income will not affect the apportionments earned, as it is not deducted from the total expenses from the earnings calculation. Now let's move on to two types of service level exemptions. Service level exemptions allow the contractor to be reimbursed for identified expenses without the required enrollment to earn it. Under Hold Harmless, service level exemptions are not necessary as a contract reimbursement does not take service earnings into consideration. However, still remains on the contract earnings calculation. The first type of service level exemption is startup. Startup are costs that a contractor incurs in the process of opening a new or additional facility before full enrollment of children. Startup is a contract term that must be pre-approved by CDE prior. Report startup costs on the startup line located on the fiscal page of the enrollment, attendance, and fiscal reports in CPARES. The second type of service level exemptions are staff training days expenses. These costs that a contractor incurs when facilities are closed and not providing services to certified children. Staff training is not a contract term and does not require prior approval. Identified in categories 1,000 through 5,000 in the CPARES reports, it must be reported on the total staff training expense line on the fiscal pages. Please note that while there is no requirement to receive prior approval to host or attend a staff training, contractors still need to adhere to purchase threshold costs associated for the training. If you have any questions about the cost threshold to host a staff training, please contact your PQI consultant for further details and information. Now let's see how these service level exemptions affect reimbursable program costs and service earnings. Remember that cost and service earnings are two of the three limits of reimbursement. First, you will see the startup that was reported. In this example, reported startup is $12,000. Next, we will see staff training expenses that were reported. And in this example, it's $3,000. To calculate the projected fiscal year net adjustable reimbursable expenses, we'll take the net adjusted reimbursable expenses of 250, 901 times the projection factor of 3.9048 plus the 15,000 from the above to get to a total of 994,718. Because we are projecting earnings throughout the year and service level exemptions are a one-time expense, we subtract the service level exemptions from the projection calculation, but then add it back in to both the fiscal year net reimbursable expenses and projected service earnings. This will be reflected in both the projected fiscal year net reimbursable expenses as seen on the screen, as well as the projected service earnings adjusted for attendance line later in the contract earnings calculation. Moving on to administrative costs. Per Title V, Section 17805, these are defined as activities that do not provide a direct benefit to the children, parents, or providers. An example of administrative costs would be the time it takes to complete the enrollment, attendance, and fiscal reports in CPARES, as this would be deemed purely administrative because filling out a report has no direct impact to the service of children. Ed Code 8258 limits reimbursement of administrative costs to not exceed 15% of net cost. Administrative costs include any allowance for indirect cost. Maximum indirect cost rate shall be 10% of the modified total direct cost. For any non-federal entity that has a negotiated indirect cost rate, the maximum indirect cost rate shall be the lesser of the negotiated indirect cost rate, or 10%. Next, let's talk about how the net reimbursable expenses projections are calculated. Total expenses are costs to operate CSPP. Net adjusted expenses are adjusted for restricted income and any service level exemptions. Net adjusted reimbursable expenses are expenses for certified children by prorating the adjusted net expenses by the percentage of certified children in CSPP. Projected fiscal year net adjusted reimbursable expenses are calculated through the end of the year using the projection factor, and we'll break this down on the next slide. So as stated in the previous slide, the first line shown above is the total expenses reported on the fiscal page of the enrollment, attendance, and fiscal report. In this example, the agency reported $400,000. Restricted income also is being pulled from the report, $97,500 in this case. No transfer to the reserve was reported. On the fourth line, we can see net expenses. This is calculated by subtracting the restricted income from the total expenses, so line 1 minus line 2. You will then see reported admin cost or admin expenses, $15,500 for this agency. Then immediately following that, you will see the maximum administrative cost that can be reimbursed, which is 15% of the net expenses in this case. The maximum allowed is $45,375. Anything reported in excess will be on the next line and will not be reimbursable. In this example, there was no excess admin cost calculated. As mentioned before, if you have any service level exemptions such as startup or staff training expenses. You will see those figures on the next line. For startup is reported at $12,000. Staff training expenses are reported at $3,000. The sum of these two expenses is subtracted from the net expenses and then reflected on the net adjusted expenses line at $287,500. This only occurs because the service level exemptions are not projected. They will be added back in the next couple steps. The second to the last line takes the percentage of certified days of enrollment and then multiplies it by your net adjusted expenses to get to $250,901. Then finally, you arrive at your projected net adjustable reimbursable expenses by multiplying the $250,901 by the projection factor of 3.90476. Then we add the service level exemptions back in and subtract any transfers from reserve to get to a total of $994,718. Now I'm going to hand it off to Jacob Lee to finish up the calculation worksheet right now.
All right. Thank you, Joey, and good morning, everyone. So as Joey mentioned, my name is Jake Lee, and I will be walking you through the remainder of the calculation worksheet here. So first, we're going to take a look at the service earnings projection. So Title V of the California Code of Regulations, Section 17812, defines service earnings as the product of the adjusted child days of enrollment, or otherwise known as CDEs, for certified children, times the contract rate per CDE, times the actual percentage of attendance plus 5%, but in no case to exceed 100% of enrollment. And we'll go over an example of what that looks like in just a moment here. So to calculate actual service earnings, it's going to be the adjusted certified days of enrollment multiplied by the service county rate, which will total the actual service earnings. Please note that for contractors that do serve in multiple counties with multiple rates, CPARIS will calculate the total service earnings for each county. And at the end of the calculation, all county service earnings are added together. Like reimbursable expenses, actual service earnings are projected through the end of the fiscal year using the projection factor. Okay, so then now let's go over how service earnings are projected. First, you see the county's total certified adjusted days of enrollment from what the agency reported. That's going to be 4,800.50, which you'll see on that first line there. This includes the exceptional needs and severely disabled days of enrollment of 450.50, which you'll see on that second line there. Next is the non-certified days of enrollment of 700.25. Then we will direct our attention to the service county rate. This county's rate is $55.27. Then we'll see the actual county service earnings. This is calculated by taking the certified CDEs from the top line and multiplying that by the service county rate, which gives you $265,000 or $265,324. This total also includes the exceptional needs and severely disabled service earnings of $24,899. Projected fiscal year service earnings takes the actual county service earnings from above, then multiplies it by the projection factor. For this example, we get $1,036,037. And this is what we are projecting the contract's service earnings to be for the entire fiscal year. Finally, we get to the projected county exceptional needs and severely disabled service earnings, which is calculated by taking the $24,899 from above and multiplying it by the projection factor. This gives us a total of $97,226 and is included in the line above. Okay, So now let's talk a little bit more about the exceptional needs and severely disabled set aside. Education Code Section 8208, beginning July 1st, 2022, says that CSPP contractors are required to set aside at least 5% of funded enrollment for children with exceptional needs, including those that are severely disabled, as defined in Education Code Section 8205. The 5% set aside is calculated by multiplying the contract MRA by the full-time exceptional needs adjustment factor of 2.4 by 5%. Contractors will be fully funded for the set aside percentage of enrollment, inclusive of exceptional needs adjustment factor, to ensure that the funding is available to enroll children with exceptional needs in the set aside at any point during the fiscal year. I do also want to note that the set aside does not increase the MRA. If you are fully earning your contract through expenses, you will not see additional funds. We'll talk more about that in just a moment. Now that we have calculated the projected fiscal year exceptional needs and severely disabled service earnings, we can look at the credit. So the exceptional needs and severely disabled service level exemption credit is calculated by taking the set aside amount in the contract, which we went over during the contract terms of Joey's part of the presentation. And then we subtract the total projected fiscal year exceptional needs severely disabled service earnings of $97,226. So we would take the 120,000 and then we would subtract the 97,226, and then that gives us a total of $22,774. This amount represents the portion of the set aside that is not being earned through enrollment. You will see the credit added to both the projected service earnings and projected expenses when we review the summary section of the calculation. Okay, now we're going to go over family fees and interest. So starting with family fees, eligible families may be required to pay a portion of the cost of care, and contractors are required to collect fees from those families. Contractors must report the amount of fees the contractor expects to collect in the report month, regardless of when the revenue is physically received. Meaning if the monthly fees assessed are $5,000, but you have only physically received $4,500 from families, you would still report the $5,000. Family fees are subtracted from the projected earnings. Now, interest, advanced contract payments are not required to be held in an interest-bearing account. However, if contract payments are placed in an interest-bearing account, any interest earned on those funds must be reported. Contract payments are in advance of state funds. Any interest earned on the funds is property of the state, and interest income is also subtracted from the projected earnings. CSPP contracts provide funding for services to low-income families who could otherwise not afford childcare services. Restricted income-like family fees can be used to provide additional hours or days of service, or to increase the number of children that the program is able to serve. So now that we know what these terms are, let's talk about how they affect reimbursement. According to Title V of the California Code of Regulations, Section 17809, fees received from subsidized families are to be expended and earned by the contractor before contract funds shall be claimed for reimbursement. Meaning, family fees are in lieu of contract payments. That is, the fees that subsidized families provide reduce the amount of contract funds that the CDE needs to provide. Family fees and interest will be projected through the end of the fiscal year using the projection factor. As I stated on the previous slide, the projected family fees and interest are then subtracted from the projected contract earnings amount. After family fees and interest are subtracted, the projected reimbursement will reflect the lesser of the projected contract earnings amount, or the MRA. Here, we can see an example of how family fees and interest affect the earnings the contract earnings calculation. At the top, we can see this agency is projected to earn $1,017,492. However, because they have reported family fees and interest earned for a total of $4,500, we have a few added steps. First, the system will calculate the projected fiscal year family fees plus interest by taking the reported $4,500 and multiplying it by the same projection factor of 3.9048. This will give us a total of $17,572. We'll then subtract this total from the projected contract earnings line to get our adjusted contract earnings of $999,920. Keep in mind that the projected fiscal year reimbursement may reflect the same number as shown in this example if it is also the lowest limit of reimbursement. Finally, we'll take a look at a full example of a contract earnings summary. This is the last section of the calculation sheet and it determines the apportionment. Here you'll see the MRA, attendance, and service earnings again. We'll talk about how this information plays a part in determining the apportionment. In a non-hold harmless year, where all three limits of reimbursement are a factor, the lesser of cost or service earnings will be stated on the projected fiscal year contract earnings line, plus the credit. However, due to hold harmless, this line reflects the projected net adjusted reimbursable expenses, plus the exceptional needs set aside credit. The reported family fees and interest are stated on the next line. As we covered in the previous slide, the projection factor is applied to the amount reported on the interest earned plus family fees line. Then we subtract the projected family fees and interest from the projected contract earnings to arrive at the projected fiscal year adjusted contract earnings of $999,920. The next line projects fiscal year reimbursement. It compares projected fiscal year adjusted contract earnings to the MRA at the top. Remember that we cannot reimburse more than MRA, even if your earnings are higher. I mentioned earlier that the set-aside credit does not increase the MRA. In our example, the adjusted expenses plus the credit does not exceed the MRA. In cases where the credit would cause the earnings to exceed the MRA, reimbursement is limited to the MRA. Here, we can see that this contractor is projected to earn 99.99% of their MRA. To arrive at this calculated apportionment for this contract, you will take $999,920, multiply it against the apportionment schedule percentage of 50%, and you subtract out the $416,000 that was paid to date, and that gives you a total of $83,960. As a final reminder, please note that the service earnings calculations are shown here, but are not currently being factored into the calculation because of hold harmless. If and when this goes away, you will want to make sure that costs, service earnings, and MRA are closely aligned. Now that we have covered how the calculation sheet is broken down, we will move into apportionment determination. As you may know, calculations and apportionments are based on projections until the June report. Contractors are advanced apportionment payments using contract earnings projections. Projections throughout the fiscal year help predict potential earning levels through the end of the fiscal year. As we reviewed today, projections are based on reported data multiplied by the projection factor. The projection helps estimate contract earnings so we can advance contract payments and provide a steady cash flow to the contractor prior to services being provided. The projected fiscal year reimbursement, combined with the apportionment schedule in the fiscal handbook, produces a flow of funds through the year that corresponds to the amount a contractor is expected to earn. Let's take a look at the apportionment schedule. Here on the screen, we have the fiscal year 24-25 CSPP apportionment schedule. which can be found in the fiscal handbook. The apportionment schedule breaks down the maximum percentage of the MRA a contractor can earn each month. The apportionment schedule has been revised for fiscal year 24-25. Contractors will receive an apportionment payment equal to 1 month beginning with the service month of December. CDE apportions 25% as soon as your CSPP contract is executed, and we have a signed state budget. This initial payment is to fund the program through September. For contractors that are required to report quarterly, all apportionment payments after October 20th are based on the reported data. The apportionment percentage will be applied to the amount a contract is projected to earn. And on the next slide, we are going to see how this applies to the apportionment calculation formula. Here we have an example of how apportionment payments are determined. So the calculated apportionment for any month is the projected fiscal year reimbursement multiplied by the maximum cumulative percentage applicable for that month minus apportionments paid to date. For our example, the projected fiscal year reimbursement from the contract earnings calculation worksheet is $990,920 multiplied by the maximum cumulative percentage from the apportionment schedule previously shown. We are using the 50% percentage for the month of December, and then we'd subtract the apportionments paid to date, which was $416,000. That gives us a calculated payment for December of $83,960. This methodology can be used by contractors when determining internal projections to calculate what payments would look like in any given month. So a contract is not a grant. An early education contractor and the CDE have a legally binding agreement in which the programmatic and fiscal requirements are met by the contractor, and the CDE agrees to reimburse the contractor for those services according to defined limits. Contractors cannot be paid more than the contract MRA. The calculation sheet covered earlier is what your agency can expect throughout the year while we are projecting earnings. The June calculation sheet will look a little different because we are no longer projecting earnings at the year end. Some differences in the June report are the adjusted MRA due to the MDO flex factor and transfers to and from the preschool reserve account, if any. I'll go into detail in the next few slides on these. First, let's start with the MDO flex factor. There's a 2% flex factor for days of operation. Title V of the California Code of Regulations, Section 17813, says that the minimum days of operation, if the contractor fails to operate at least 85% of the minimum days of operation required in its contract, ceases operation, or the contract is terminated prior to the end of the contract period, the maximum reimbursable amount shall be reduced in proportion to the percentage of the contract minimum days of operation that the contractor was not in operation. If the days of operation falls under 98%, the contract MRA will be reduced accordingly. So we have the example of 98% of the MDO will calculate as 100%, and then if you had 97% of the MDO, that will calculate as 97%. Because it was under the 98%. So if you're operating less than the MDO contracted, it can cause the contractor to fall below the 98% threshold and can affect the reimbursement. This is why it is important, if there is any change in the MDO, that you contact your PQI consultant prior to June 30th to submit a program narrative change to make those adjustments. The following two slides will illustrate a June report with the two scenarios. Let's go ahead and take a look. Okay, so the first example is with a contractor who is meeting their MDO requirement. We see here that the contractor reported 246 days of their 246 days contracted, which wouldn't be 100%. Because of this, the contractor's MRA and total adjusted MRA is unaffected at $1 million. Because this contractor's contract earnings was also $1 million, it didn't affect their reimbursement at all. Okay, so then here we have an example of a June report where the contractor only reported 241 days out of the 246 days that they had contracted to be open, and no updated calendar was submitted. This caused the percent of MDO operated to fall below the 98% threshold. So notice that the adjusted MRA decreases from 1 million to $979,975. Serving a difference of 2% or more of the MDO decreases the maximum reimbursement you can receive. This directly affects one of the limits of reimbursement. So now the most this contractor can earn is the adjusted MRA. The contractor lost out on $20,025 in reimbursement simply because they never submitted their updated calendar to their PQI consultant. Okay. EENFS will determine whether a transfer into the preschool reserve is appropriate. When a transfer into the reserve occurs, you will see the transfer on the year-end contract earnings calculation worksheet near the bottom in the summary section as shown here. For this example, the transfer into the reserve was $25,000. The year-end contract earnings calculation and/or contract closure may result in a billing due to an overpayment of contract funds. If the year-end contract earnings calculations does result in a billing, the contractor will receive a preliminary billing notification. Please know that this is not an invoice, but is considered a notice to the contractor of a potential future billing. Okay. Contractors have until the revised report deadline to submit and certify revised year-end report data. The revised report may alter the billing amount or calculate an additional payment. If an audit is required for the contractor, this preliminary billing may also be adjusted by the data that is submitted with the annual audit report. Note that Education Code Section 8335 allows contractors that received less than $100,000 from any state agency to submit a biennial audit of the entire organization. Any contractor receiving more than $100,000 is required to submit an annual audit. These unearned contract funds should be available in the contractor's bank account. However, if the contractor has spent these funds incorrectly, the contractor is responsible for replacing state funds with its own non-state funds. Billings that are delinquent shall result in CDE contract funds being withheld. All right, let's close out this presentation with some best practices regarding monitoring your contract through the year to better earn your contract. After each reporting period, contractors should review the calculation worksheet to track their MDO, looking at their program calendar to verify accuracy. Also ensure that the CD 9400 with attendance information is reconciling with what is being reported on the enrollment, attendance, and fiscal reports. If the MDO is not aligned with your program calendar and needs to be updated, contact your early education consultant prior to June 30th. Contractors should be tracking their service earnings and net reimbursable costs. Even though we are in a hold harmless year, aligning your costs with your service earnings is still very important. Next, contractors should be reviewing their exceptional needs and severely disabled set aside to see if they are meeting the 5% requirement or if the contractor will be receiving the exceptional needs severely disabled credit. Lastly, contractors should monitor their projected contract earnings and assess if their projected earnings are higher or lower than the MRA. and if they're participating in our transfer periods if appropriate. We will have another webinar soon regarding the transfer periods in more detail. Please contact your fiscal analyst with any questions regarding your enrollment, attendance, and fiscal reports.